Hello, my name is Charles Lipinskis from the Chester Community Law Project, working in partnership with the Cheshire and Warrington Business Growth Programme. This video is tailored around financing private limited companies and stems in two directions. Firstly, Emma Louise Simpson will walk you through what debt finance is and how you can use it. And then we're going to move on to equity finance, which is going to be led by Graham Herschel, where he will explain what equity finance is and again how you can use it to grow your business.
Debt finance, what is it? So it's one of the most common ways in which capital is raised within a company. A company would normally borrow money to be paid back at a future date, inclusive of interest. Lenders in return become a creditor to the company and will become a liability on company accounts. Unlike equity finance, debt finance comes in quite a variety of ways. Most commonly, you'll have an overdraft. Now, this is normally for a short-term period, and these are of low interest. Then you move on to loans. Loans are normally fixed payments over a set period of time, and these will be inclusive of interest rates. The good thing about loans is you can shop around and you do get quite competitive rates, although they can be restrictive in nature, as obviously once they're taken out, they can incur early repayment charges, and they do show on credit reports. They can't be transferred. That person is obviously liable for that loan. Hire purchase. So these are really good for high value purchases, such as maybe investing into new machinery, cars. Again, very similar in nature to a loan, fixed payments, inclusive of interest over a period of time. Often you'll find that they are of high interest, so a little bit higher interest, and you'll end up paying a little bit more back than you would with a loan. And although that you are responsible for the asset, ownership of the asset doesn't actually transfer over until all the payments are made on that hire purchase agreement. So that's something maybe to bear in mind if you're debating over a loan or a hire purchase. With a loan, you will have ownership over the asset, although you will be liable for the loan. Hire purchase, you probably pay slightly higher interest rates. Again, you will be responsible for the asset, but you don't actually fully own the asset until all the payments have been made on the agreement. And lastly, charges. Fixed or floating charges are a way to generate capital over the asset that's already in possession. So for instance, a fixed charge, you could say a mortgage. A mortgage will be gave out over a term, which is a set period of time, inclusive of interest, and that will be done unsecured on the building. Or a floating charge, which could be something, say for instance, stock. So you'd have £500,000 worth of stock. You could take out a financing agreement with somebody and use your stock as your asset to generate capital. As mentioned earlier, there is an element of security over your asset. So lenders in return will get guarantee of a debt repayment when lending to you. Lenders are in control of this, although it helps you with forecasting and cash flow. As having set payments, it's easy to foresee what you're going to be paying out each month and how long for. Another thing that is favourable with lenders is when they become a secured lender, should anything happen to the company, they will get priority on winding up, so they are guaranteed a payment at the end of it. One thing to bear in mind is something called the quick test. It's also referred to as gearing or an acid test. And what is it? It's the ratio of debt to equity within a company. It's a useful thing to know as it's a measurement of risk. So if the amount of debt to equity is too high or highly geared, it can lead to financial distress. And lenders will often use this as a tool as part of their duty in being responsible lending. So here I've listed some pros and cons. Pros of the debt finance is you don't need to give up control of the business. You simply are taking out a finance agreement. You're not giving up any control whatsoever, like in equity. You get tax relief on your repayments, meaning that the amount of tax that you'd pay for the company would be reduced. It makes payment forecasting very easy. It's very straightforward to apply, and you get that instant cash flow straight away. The cons, as mentioned earlier, they can be restrictive over the free movement and the sale of the assets. They are legally binding, so payments must be made in times of hardship, which could create long-term cash flow problems at a later date. Also, if you decide to do a charge, you are legally obliged to register this charge, and it can be seen on Companies House and could impact any future borrowing should you default on them.
Just to conclude on this subtopic, the government does have a section of their website dedicated to business finance, and I have included the link in the comments below, so definitely give that a look. Now on to equity.
What is equity financing? Well, investors buy a stake in your business. You give them the shares and they give you the cash in return. Investors do not generally have the right to interest or capital repayments. However, they do hope to receive dividend payments, which directors only need to declare when the business is turning a profit, or even then, there is no requirement to do so. A dividend is a distribution of some of the company's earnings to a class of shareholders. Dividends are usually paid in the form of a dividend check. How does equity financing work? Basically, you have to value your business, so it's key that you have a realistic value of exactly what the share price is for your business, so you don't overprice yourself or in turn underprice. A few types of equity financing: seed capital, equity crowdfunding, angel investors, private equity and venture capital. As you start off, seed capital is often the first type of equity funding, usually between £10,000 and £30,000. Seed capital is typically given by early stage investors such as family members who believe in your business idea. Types of shares: transferable shares versus non-transferable shares. Transferable shares are shares that can be traded between buyers and sellers at a mutually agreed price. Non-transferable shares are shares that must not be sold, transferred or exchanged or assigned or pledged. Cumulative shares. At the end of the financial year, the directors of a company have the option to declare a dividend, which is essentially the profit. This is once the overheads have been paid, i.e. debts, etc. The directors do have, however, have the option not to declare a dividend and to potentially divide the profit back into the company. However, this potentially leaves the investor wondering where their profit is. With cumulative shares, this means the investment of, say, for example, 7p in every pound will roll over until the following year, or potentially until the company declare a dividend. The investor will not lose any money. It will effectively roll over, similar to as explained to me, of kind of like the lottery. This will continue to roll over until the company decide to declare a dividend. Non-participating preferred shares is one in which a dividend is paid, usually at a fixed rate. This is not determined by the company's earnings. Holders of these type of shares do not participate in the distribution of profits to equity investors. Non-voting shares do not give the holder any voting rights in the company. This means the holder is entitled to a portion of the company's capital, but is not able to take part in general meetings or decisions. Redeemable shares. These are shares that are designed for investors that potentially want their investment back in the company. In turn, they decide they want to retract their money or their investment. The company must have assigned these as redeemable shares at the point of purchase. A quick example of this would be a shareholder would create a 4-year redeemable share plan. So, for instance, in 2021, the plan would be created to be redeemed in 2025 and any subsequent profit received. The company do have the option also to buy the shares back. However, you must ensure that these shares have been paid in full. For example, somebody buying, say, £50,000 of shares may have only paid off 25,000, so effectively only own 50% of those shares. There are, however, disadvantages and risks of equity financing. Effectively, shared ownership. In return for the investment of the funds received, you are sharing your business. Ultimately, you don't have full control of your business either, so you are sort of sharing the decisions as well, potentially with other business investors. Your personal relationships may be affected if for reasons that the business is not going too well at some point, or a family member wants to release anything money-wise, then you will need to be careful that your relationships don't break down. And this, of course, will enter potential conflict with the investors. The percentage you give away is very important. We recommend 25% as a maximum. You want to try and keep control of your business as much as possible, and definitely anything up to that 50% and anything over 51% will lose complete control. Below are some links that I think you will find useful. The first link is through the .gov website, so it's government backed and it's called Funding Circle UK. This will give you an idea of the criteria that you need to fit, i.e. limited company sole trader, to be able to get these finance support loans. The second link again is through the .gov website. This does open up to more options available. There are other avenues that you can take within your company that may best fit the way your company is structured, so definitely worth having a look. And the third link is through British Business Bank. Again, this is government backed. All the links are government backed schemes. This last link will give you a bit more of an oversight of things I might not have gone into in too much detail. So what is equity financing, how equity financing works, is a broader overview of exactly what information you need. Thank you.
So this draws an end to another video by us at the Chester Community Law Project in partnership with the Cheshire and Warrington Business Growth Programme. I do hope it's been very helpful for you. Check out all of our other videos to ensure that you are doing what you can to grow your business as best as you can.